The topic of today's webinar is your PPP loan, latest updates, and more on forgiveness. If you want to find out about the latest on PPP loan forgiveness, you come to the right place. My name is Carter Freeman, and I'm the Vice President of the Western Region here in Denver, Colorado. For those of you who are new to VCFO, we are a professional services firm specializing in finance, accounting, human resources, and recruiting. With offices in Dallas, Austin, Houston, Denver, VCFO has been helping clients grow stronger since 1996. With me today are Michael Bennett, a consulting CFO in the Denver office, and Darrell Tesmer, Chief Compliance Officer and resident PPP expert from our Austin headquarters. If you have questions, please submit them with the Q&A button. We will respond to as many as we can at the end. If we can't get to them all, we'll do our best to get them to respond to them on our website. And then also we will publish a link to the recording of today's webinar with a follow-up email. So our agenda today, we'll do what I would call a PPP 101 recap, a recap of our last webinar, and include some of the latest updates for topics that we discussed in the last webinar. There have been two big developments since. One has to do with economic necessity of the loan, and most recently, the SBA has come out with details on forgiveness. They've published a forgiveness application with detailed instructions, supporting worksheets and the like. It's very much like an IRS tax form, the way it's put together. It's very detailed, fairly complicated, somewhat labyrinthine, but it's also very specific. And in working through it, you can kind of understand the spirit behind a lot of it. And as with anything like this, it raises some new questions and there's some unanswered ones. So I'm going to hand it off to Michael Bennett for a moment to do a recap of our last seminar.
Yeah, thanks, Carter. So I'll be taking you guys through the recap, and just note we've got some text here that we've highlighted in red. So if you were part of our last session, we'll be covering a lot of that again, just at a quicker pace, but we've highlighted some new things in red here. So first of all, we want to step back, and before we dive into the actual forgiveness part of the PPP and the nuances here, I want to just remind everyone to potentially step back and think strategically about what we're doing here. So for a majority of the cases, and what we're going to assume on this webinar, is that we're all trying to maximize our debt forgiveness as much as we can. We're going to maintain our workforce and bring our employees back to work. And we'd like to reopen our business as fast as possible. That may not be the case for a lot of folks. So I would just say, before diving into making these decisions that may have short and long-term impacts, that you think about strategically what you're doing. So really the first thing I would do is set up and develop an 8-week forecast and work with your team and think strategically. And guidance is changing. You're going to see as we go through this presentation, the guidance is changing very rapidly. As soon as Friday, a bunch of stuff came out. And so, having a nice forecast that you can, run scenarios with and make sure your team is on the same page, just highly advise doing that. That'd be the first thing. So that's it for strategy. Next slide, please. So tactically, a couple things to think about. Now, the first of which here, if you were part of our last webinar, we talked about the covered period, and it was a little unclear in terms of, when exactly does this 8 weeks start? When does it end? What are the nuances here? There's been some subsequent guidance on that. They have further defined 8 weeks as 56 days, just to make sure there's no misconception there. So 56-day period. Now, they've set up a covered period which starts at the date of your loan funding. So if you got your proceeds on May 1st, the 8-week window starts on May 1st for most of your expenses. What they've done with what they're calling an alternative payroll covered period, and I'll refer to it as the alternative period for the rest of the presentation. What they're trying to do here is, when we went to it last time, we were a little unclear in terms of how to, to manage payroll during this period with all these set cycles. And what they're saying here is, you can use this covered period, which is 8 weeks starting from the funding date. But for payroll costs specifically, they're going to grant a bit of an extension here and say that period will start on the first day of the first period after your funding. That applies to if you're processing payroll on a biweekly or more frequent basis. So for example, if you received your loan on May 1 and your first payroll date is May 6th, and you're processing payroll biweekly or more frequently, then that 8-week, that 56-day period, it starts on May 6th. So they've made an alternative exception here for payroll costs. So other things you can do tactically, we'd recommend capturing and isolating all of your PPP expenses as soon as possible. So just as if you were, working with a construction loan or other form of reimbursable debt, make sure you capture those expenses right away, start segregating them and tracking them. That will include anything, that'll include payroll registers, 941s, invoices, those types of things. And then it's not required, but we do recommend setting up a separate bank account for your PPP funds. So, treating this like a trust account. So having one account where you have the receipts and all the related disbursements, funneled through one account is obviously going to be the cleanest way and the most defensible way, when and if you have to go through an audit. But again, it's not required. And then finally, make sure you're monitoring the SBA and the Treasury website. So again, new guidance came out on Friday. We're sure this is not the last of it. We'll be providing webinars, as we go and we learn new things. But if you don't get a hold of these, new webinars, make sure you monitor those sites. Okay. So expenses that do qualify, a couple minor changes here. This is the most interesting change for me. It's they've defined payroll costs as, and again, before we talk about the period, payroll costs being explicitly, gross pay, sick pay, medical, family leave. It includes state and local employer payroll taxes. So not the federal portion, but the state and local. It includes health insurance, and it also includes retirement plans. So the new stuff that came out was the how payroll costs are calculated and how which ones fall into this formula. And it's basically what we believe is the combination of payroll costs paid during the covered period or the alternative period. So any payroll costs where cash has gone out the door and it's been paid, or payroll costs incurred during the alternative period or covered period and paid before the next payroll cycle. So we believe that the way the language is stated in the in the forms and in the guidance, that it's the combination of these two. So it's the combination of cash payroll costs paid during this 8-week period, and also payroll costs that are incurred during these periods, and as long as they're paid before the next payroll cycle. And the way they defined, when are payroll costs paid, that is simply when checks are distributed or ACHs are originated. So those are really the major changes to payroll costs. So next slide. In addition to payroll, again, we continue to see these other qualified costs. So these are, again, you can have a maximum of 25% of your PPP costs associated with these other qualified costs. And the period, they've expanded on the period a bit. So what they're saying is it's, similar to payroll, it's qualified costs that are paid during the covered period, or they're incurred during the covered period and paid on or before the next regular billing cycle. So for example, if you had a rent payment due for the month of May, and you make that rent payment in June before the end of the next billing cycle, that should be included as a forgivable qualified cost. So they've expanded their definition on the timing of these costs. Now again, the major categories that they've outlaid for these qualified costs are interest on mortgages or other debt obligations, So not the principal portion, but the interest associated with those obligations. The other one is rent or on real or personal property. So this would include office rent, but it also includes personal property rent and leases. So if you're leasing a copy machine, for example, that could be included as a qualified cost. And then utilities for which service began before February 15th are also included. So you'll notice with all of these other qualified costs, they really drew a line in the sand and picked a date and said, by February 15th, if you had, these debt obligations or utilities or other arrangements in place, we're gonna allow those to be considered qualified costs. So make sure keep in mind that there is that magic date of February 15th where these obligations, are required to be in place before that magic date. So those are expenses that do qualify. A couple of, to elaborate on 3 of these areas here. So, what can I include as it relates to other compensation? So again, the intent of the PPP program is for companies to pay and retain their employees. So it's, very clear in the guidance, that's what the intent is for this program. They're not explicit on the form of compensation that really is excluded. So for example, bonuses, commissions, all these things are considered compensation, and they really have not definitively excluded specific types of compensation. But what they have done is they've put a limit on it, they've capped it. And so any comp paid to anyone in excess of $100,000 annually is going to be excluded. So that equates to $15,835. So if you're paying, it could be salary, it could be a bonus, it could be a commission. But if you've paid anyone in aggregate of this magic number of $15,835, anything above and beyond that would be excluded. So just keep in mind when you're running your cash forecast that's a pretty key item there. In terms of utilities, there was a lack of clarity last time we ran this in terms of what would be considered utility. They further expanded on the definition there. So in green, it's explicitly stated in the form and the guidance that utilities do include electricity, gas, water, transportation, whatever that means, telephones, and internet access. A lot of people have asked, do cell phones count? Are they considered telephones? It doesn't say that. So, if you've been, running cell phones through your business and they're considered an operational cost, it's reasonable to assume that could be considered a utility, but there's no explicit guidance on that. So we marked it as a yellow font there. And then lastly, rent or lease payments is a tricky one because it's pretty clear that your traditional office rent would be forgivable, but what about, property taxes or common area maintenance charges? So, this one's a little gray. That's why we have it classified in yellow here. I mean, if your rent payment, is CAM and property tax charges included, and it's one payment, well, I guess it's reasonable to assume that that's a form of rent. If it's a separate bill and you're paying property taxes separately and it's on a separate cycle, I don't know, that could be a little more gray. So again, there's not definitive guidance on this. I just recommend to use your judgment and make sure it's reasonable, and then you can defend it and use your own judgment for the calculation. And we could very well get additional guidance on this in the next couple of weeks. So now those are items you can include. They're a little more explicit on what does not qualify and what is not forgivable. The first one there is probably the most, the one I've heard most questions about, and that is independent contractors. So when the original guidance came out, it was a little unclear. It seemed like you could consider independent contractors as payroll costs. But if you haven't figured out going through the application process, independent contractor payments for companies, that is excluded. That is not considered payroll. And the intention, it looks like, was that independent contractors are going to qualify for the PPP program independently, and that's likely why they have not been considered payroll for companies' purposes. So that's number one. Compensation paid to an employee, outside the United States. We talked about the cash compensation to an employee in excess of $100,000 annually. Federal payroll taxes are excluded. So again, when the state and local portion of the payroll taxes are included, but federal is excluded. Qualified sick and family leave wages under the Families First Act, those are excluded. And then any mortgage prepayments or principal payments. So whereas the interest on those debt obligations are forgivable, the associated principal payments or any form of mortgage prepayments, those are specifically excluded. So those are expenses that do not qualify, and I'm going to hand it back to Carter to talk about some of the more recent significant updates.
So economic necessity, it's really fascinating how this has gone from almost a societal or political standpoint. So the SBA, the government came out and responded to this crisis, and for all intents and purposes said, here, fill out this form, send it in, and we'll send you a pile of money and you don't have to pay it back. And lo and behold, people did that. And then in the first wave, a lot of very large companies did it, well-heeled public companies did it, high visibility companies did it, and they sucked up all the money. And so there was a backlash against it. From two standpoints. One, it was companies that didn't really need it, and the smaller and mid-sized companies who probably needed it more were shut out of the first round. So there was some guidance that came out that says you must document the economic necessity of the loan. And in fact, on the application, it's one of the things you have to sign. And if you're found to have taken this money and applied for forgiveness in bad faith, there can be all sorts of penalties, and it can be way more than the original loan was. You can go to jail, do not pass go, do not collect $200, and that just scared a lot of people. A lot of people gave the money back, some appropriately so. And then so the pendulum then has now kind of swung back to the middle. What they've said is, if you took a loan under $2 million, most likely you need it. So you have a safe harbor with respect to economic necessity. We're going to assume that you needed the money. You have to calculate forgiveness and all of that, but you've got a safe harbor for economic necessity. For loans 2 million and over, you still have to be able to demonstrate that you have economic necessity. However, if it is determined that you did not have economic necessity, you're no longer at risk for penalties and all sorts of other horrible things. Your forgiveness is at risk. You would just simply have to pay the money back. So in thinking about whether your loan was economically necessary, there's really two things. One is the COVID crisis. Has it had an adverse effect on your business? And is there a reasonable risk that it will or could? And that typically is made manifest through lower revenue. It impacts your revenue, or it disrupts you operationally, which typically equates into higher costs. Also, liquidity, which would be your cash reserves, your access to capital. Or are you in a position where you have some vulnerability with respect to your liquidity and your ability to withstand the adverse impacts? Those are the two things to think about. So what you need to do is right now write a memo and document your thinking on it. And also, to the extent that you have numbers and the like that you can point to, now's the time to do it, rather than trying to remember in 2 years when you're going through an audit what your thought process was. A couple of other thoughts about risk and perception with the benefit of 2020 hindsight is the size of the loan. The bigger the loan is, the more risk there is in it, the bigger of a target you have. And also, do you have a visible adverse impact or pressure on your liquidity? Some companies, it's a no-brainer. It obviously has impacted their business. They obviously have liquidity issues and don't necessarily have access to capital. Other ones, it can be a no-brainer in the other direction. It's the areas of gray where there's more risk, if you will. But the risk is that you lose forgiveness. Nobody's going to go to jail over this. Next slide, please. So they've come out with this form that has very specific calculations, this application form, and I'm going to walk through it. So this example that I put here is right off of the SBA form. You put in your payroll costs, you put in your interest payments, you put in your rent, your utilities. If you've had a reduction in your workforce, a reduction in salary or hourly wages paid, then there's a reduction calculation. You come down to a number. And then if you had a reduction in FTEs, they have this concept of an FTE reduction quotient, which is a measure of how much your workforce has shrunk. You multiply by that and you get a modified total. So you compare your modified total, your PPP loan amount, you take your payroll costs and divide by 75%. That's limiting your non-payroll costs to 25%. So you calculate those three numbers, and whichever is the lowest one is your forgiveness amount. And then if you've had an EIDL advance, I know some folks did this, you got that $10,000 advance, you don't have to do anything with it, but the SBA will deduct it and you'll get to your net forgiveness amount. Doesn't look that complicated, right? We'll just do this in the morning and then we'll go to lunch whenever they open the restaurants. The devil, of course, is in the details. Next slide. So the payroll costs. The cash comp, they break into three different buckets. You're looking at your covered period or your alternative period. And the first bucket is employees who were with you in 2019 but had annualized salaries less than or equal to $100,000. Or they were not employed by you in 2019. You lump all that together. And then you have cash comp to owner employees, people who are self-employed, and general partners. And this parenthetical disclosure, if you will, is limited to your average 8-week pay for 2019. The owner can't give himself a big bump in 2020. Sneaky buggers doing that. So you put that in, and then all your other employees. So that's the cash comp. And then you add in your health insurance, what you paid into retirement plans, your state and local taxes. That gives you your total payroll costs. Next slide. So this is where it starts to get, the devil really starts to get in the details. So we're now looking at folks who are employed, who are with you during your covered period or your alternative period, who had 2019 annualized comp of 100,000 or less, either that or they weren't an employee. And you go through this calculation to get a salary reduction. You calculate, so this table that you're seeing, the one on the left, you have to do this for every single employee. In practice, you likely have a spreadsheet where you have each employee on a row, but this is how the calculation works. You put their comp during the covered period. You put whatever what their full-time equivalency was. And then you annualize their salary for the covered period, and you compare it with their annualized salary for the first quarter of 2020. And you figure out, you calculate what the salary reduction was. In this case, it was 31%. So what you're looking at is the excess reduction over 25%. So you take the annual salary from Q1 and you are basically converting it to 8 weeks times 8 weeks divided by 52 weeks. And you come up with an 8-week comp structure for the Q1 period, and you multiply times 6%. And that gives you your salary reduction. So you do this for every employee in this under $100,000 in 2019 bucket. However, there's a safe harbor. You can possibly get out of this. You look at whatever their annual salary was on February the 15th, you compare it to what it was in this period of time, February to April. And if it went down, if they had a reduction, and then you cured that reduction, you brought it back up to what it was at February 15th, by June 30, you get a hall pass. You have no reduction. So you see, so, you know, the strategy or the impact with this for some people anyways, if you've got somebody, you're doing this on an individual person level who's had to take a hit during the COVID period, and you restore them by June 30, you get a hall pass on this. So if you're going to restore them, you don't want to restore them on July 1 to what they were making before. You want to do it by June 30. So a couple of other details. There's a similar calculation for hourly employees. I won't go through it. But effectively what you're doing is you're converting to an hourly rate, and what they're driving at is, did people get a reduction in their hourly rate? There was some question before about what was an FTE, and they've specifically stated it's based on 40 hours a week. You don't do anything with overtime. The max that any one employee can have that they can be is 1 FTE. And then for part-timers, there's a simplified method. If somebody works less than 40 hours, you can just use 0.5, or you can calculate whatever it is. Next one, please. So for would be your other employees who had an annualized comp of greater than 100,000. Oh, can you back up to the previous slide? I forgot something. There's a big caveat. There's a big zinger with this under $100,000 in 2019. The wording in the CARES Act says that that you would only include employees in this who how would I put this? It's not just looking at the whole year for 2019. You have to look at every single pay period and annualize it. And if anybody exceeds it, then they're no longer under $100,000 in 2019. It kicks them into the next bucket. The wording is a little bit different on the form, so there's some unclarity about this, but potentially it's not just all the pay periods run together. It's if any one pay period, like if somebody got a big bonus, it could kick them into the greater than $100,000 category. So next slide. I'm sorry, next. Is it advancing or is it me? So for folks who their annual cash comp was for greater than 100,000, you calculate their pay during the covered period. It cannot be more than $15,385. And then you calculate their FTE, which those are two numbers that you're going to need. Next slide. So then you have this FTE quotient reduction. So what you do is you're doing this you're adding up all the individual employees, and you're calculating the company's total FTEs during the covered period, and you're comparing it to 2 previous look-back periods. And you can use whichever one you want for this calculation. Obviously, you want to use the one with the lowest number of employees, and you calculate an FTE reduction quotient. But like the did I go over the safe harbor? Go back up one. One more. Oh, I think I may. So it's a lot like the safe harbor. Is that if your FTEs go down and then they go back up again, then you get a hall pass. So I'm sorry, the next couple of slides, I'm sorry. One more, there we go. So it's the very, it's the very same concept. You have the FTEs at a certain point in time, you have your average FTEs during the first part of the COVID crisis. And then if your FTEs went down and then you restored it as of June 30, then you have an FTE reduction quotient of 1. You have no reduction quotient. You're doing this you're looking at this on an individual basis. So there are some exceptions. If you had somebody leave, if you had somebody that you let go or furloughed or laid off, you gave them a good faith written offer to return and they rejected it. If you fired somebody for cause, if they quit, if they asked for and received lower hours, all of those are exceptions. If you fill that with a new employee, you can effectively put the new employee in the shoes of the old employee. So so you won't get dinged on your FTE quotient for these reasons. Next, please. So that's it for the calculations. There's also very explicit guidance as to the documents required to be submitted. In fact, there's an entire page, single space, talking about what documents you need. But basically for payroll, they want to be able to verify your cash compensation and benefits. So your third-party payroll provider reports, 941s, payroll registers, bank statements, tax forms. You're having documentary evidence of who got paid what when, and when you paid your employees. Also, with respect to your FTEs, you need to provide support for the number of FTEs that you had at different points in time. Next. And then for non-payroll, they want support for the non-payroll costs, which would be utility and their invoices, receipts, canceled checks, maybe a bank account, something that so they want to be able to see the bill and they want to be able to verify payment. There's more stuff. It's an exhaustive list, and then they also have a list of additional documentation it's required to be held on to, presumably in case when they come audit you, but you don't have to submit it to them. So let me see, next slide. So I'm going to pass it to Michael.
Yeah, so we'll end with some questions here. We see a number of questions coming through. We'll get to it, what we can. And we'll just kind of end the presentation saying, we're obviously here to help. So, if you guys need help, with strategy, determining how you want to navigate through the PPP process, any assistance with forecasting, cash modeling, we're taking on engagements where we specifically work with clients on, explicitly calculating forgiveness or just any general advice. So we're obviously here to help. And with the remaining time here, we will start fielding some questions.
Well, thank you all. This is Darrell Tesmer. I'm very pleased to join you this afternoon and talk about something that, again, is a brand new update. Seems like we get these weekly, if not daily, from Treasury and SBA. So we're trying to make sense out of the new form and instructions, and I see many questions that are centered on that. I'm going to take a stab at one or two, and then we'll kind of work until the end of our session. If we don't get to everything today, again, we will do our best to put responses out on our website or get back with you in person. So let's see, here's a question about the period. So the form has introduced this concept of a alternative covered period for payroll. And the question that we've received says that I've got my funds on May the 4th. We do our payrolls though on a semi-monthly basis. We're paying on the 15th and the last day of the month. So do I have an alternative period? And the answer is, based on the instructions we've read, is that you can only choose the alternative period if you are a bi-weekly or a weekly payroll process. And so your particular covered period, if I'm understanding the instructions, since you're so new, would be is the day that you received your funds, which is May the 4th. I'll try another question, and here's one that has come in. It says, I did not include lease payments when we originally applied for our loan. That is a very high number, a significant sum, and it could have been added to our funding. Can we go back and try to get more funds? The answer is, as I recall, in the original form, the application to borrow the money, it was based on 3 or 4 things, but leases, I don't believe were included in the list.
Yeah, that's right. The original loan was based on 2.5 months of payroll. And the forgiveness is based on basically 8 weeks of payroll plus some other stuff, leases and such like.
Correct. So I
think the answer would be no.
Yeah, I think the answer is that you wouldn't be able to revise the loan amount purely on leases, since they weren't in the calculation to start. They just happen to be in how you can use your funds and the forgiveness of funds. So another question here that is come in is, our bank is having a lot of delays setting up brand new accounts. They have a backlog of requests. Can we use an existing account? Further, we've zeroed out that account so that we can make it ready for the funds. And so the answer is, I think that's perfectly fine. You've got an account that, as long as it doesn't have any sort of other conditions or restrictions on it, you could potentially move funds into it and then start to account for your disbursements.
Yeah. I mean, it's a really good, question. Like, if you have a main operating account and you've got a lot of things bolted to it, like payroll comes out of it, your 401k contributions come out of it, your bill pay is hooked to it. It's a real pain in the neck to try to hook those to another account. So, it's like you're treating it like a trust account, right? And what you do is you disperse money out of your regular operating account, you move money from your PPP account into your operating account, and you do it in such a way that it's very identifiable. Like, you could do it like, there's a number of ways you could do it. You could do it on an individual transaction basis, or you could like maybe, do a spreadsheet where you add up all the things for the week, and then you just do one transfer a week. The whole idea behind this is you want to be very explicit about, this money is for specific purposes, and that's what we spend it on.
Again, not required. So it's basically a recommendation, but you could just as easily do this, through another method, Excel. I mean, if, depending on how your accounting processes work, it's not a requirement.
Correct. But again, consider if there's any sort of resolutions or restrictions tied specifically to that account. And off of those will be documents that you may have signed when you open the account. And therefore, if you start to use it for funds related to your loan, but it was set up for another purpose, you may need to clear those hurdles before full use. But generally the concept is okay once you get past that check. Another question here that's referring to, we are paying our employees as temporary employees provided by an agency. Also, we have housekeepers that we pay through 1099. I guess what I've read, I've seen that in both these cases, because they are not part of your payroll. If you went to your payroll provider and you said, you maybe asked them for documentation, or if you ran your own 941s and gave them as support, these workers would not appear in your payroll cost. So I'm not aware of an exception for them to be included as eligible amounts. I don't know, Carter, Michael, if you have thoughts about that.
I had somebody that I know who, in respect quite a lot, who said the letter of the law says that if you have people who work for you full time on a 1099 basis and don't apply on their own, that you can include them, but that everything that the SBA has put out has said, no, you can't. I've heard that from one place, but I think most everything I've heard is that you can't. The idea was that 1099 people can go apply. They can apply for the SBA loan themselves.
Well, there is one subject to there is some guidance I've read, and I apologize for not having it in front of me, but I would recommend searching for anything that's been issued related to PEOs, because I have seen concern when the loans were first applied for that, there wasn't payroll information because the employer of record was a PEO. So there may be some more there. It's a good question. It's one I'd like to maybe look into and see if we could give you any updates if they're out there. So I see a question here asking about, is there any guidance on bonuses paid during the covered period? Well, I had that question yesterday. As you read through the new form, I nowhere in it found the term bonus. I could have missed it, but it looked to me like they, in almost every case, had used the term salary or wages or hourly wages. However, they do refer back to the definitions, both in the act and also in their interim rule. And in those definitions, there is a fragment of a sentence that says, and other compensation. So we continue to interpret that bonuses are eligible and can be used in the covered period or alternative period, subject to this one question. What is the nature or reason for payment of the bonus? And if it lines up more towards the retention side of things, or it was some binding payment that's it's due and it's required to be paid because it's part of a employment agreement or some performance agreement, those are great reasons. But if the bonus is just paid purely to maximize loan forgiveness, then there may be more questions when those cases come up.
Yeah, and I'd say again, this is a gray area. This comes up all the time, but I would say that it looks like that the way they're controlling that is they put that cap. And so, there is a limit to doing these things, right? If you can't pay anyone more than $15,800, anything above and beyond that is going to be excluded. So you hit that pretty quick when you start paying out bonuses and you annualize it. So anyways, that's
a good point. Yeah, it's a good point.
I
think we'll do one more question.
Right.
Yeah, one more question before we conclude. I know there's several more in here, and they're great questions. There's one here that's talking some about we've had turnover, and there's different employees in 2020 than 2019. I think we touched on this. There in the instructions, there are specific reasons for exempting some of the counts for people who may have left or people who do not want to return to employment. There's numbers of reasons that they might say that they don't want to resume employment with you. So they provided exceptions for those, and they're in the instructions. The best thing to do there is to look at those on a case-by-case basis.
I think what we're getting at, what's a little confusing about the way the calculation works is you're looking at what you paid people in your covered period, and you're comparing that to a period earlier in 2020 is what you're doing for the salary part of it. But in doing so, you have to put your employees into two different buckets. And one of the buckets is employees who made less than $100,000 in 2019 or weren't even working for you. And the other bucket is people who paid more than $100,000 in 2019. So, what's peculiar is it's like you're looking at 2019 for the purposes of figuring out which bucket to put people in, but whatever you paid them in 2019 doesn't really figure into the calculations themselves. You're not looking back to 2019 for the salary reduction. Anyway, I think we're getting to let's see. Maybe we have time for one more.
Let's take a look.
Yeah. Well, here's one. Here, I'll do one. It says, if we did not reduce salaries during the PPP duration, do we need to complete the salary reduction calculation? And, I guess the answer was you have to go through the answer would be you have to go through the motions and your salary reduction will come up to zero. But you have to demonstrate that. You have to do the calc. and show that that you have no reduction.
Right, and that actually is a great point. Now, there's up to this time, there's only been an act, there has been narratives, there's been frequently asked questions. This is the first time that we've actually seen what Carter described as a pseudo tax form. And to go through loan forgiveness, this form will have to be filled out, documentation will have to be provided. If it's not done that way and in accordance with the instructions, there's risk, there's questions about whether forgiveness will be given. So my suggestion now is if you haven't found that form, it's on the SBA's website, pull it down. It's 11 pages, but I believe there are 3 pages in it that I've read that are probably most critical. But just like any other new thing, as we mentioned, it's likely going to have some change and some more guidance coming as we start to work with it.
Well, I want to thank everyone for participating. Be safe, be well. Almost certainly more to come. Stay tuned.
Thanks, everyone.
Thanks.
Goodbye.